This store here looks kinda normal, but it makes 3 times more in profits than a normal Reliance or Spencer's store. And this is one, but when you combine all 300 of these stores together, they make $300 billion in revenues yearly. This is the business empire of DMart, India's own homegrown big box retail chain that came from zero in 2002 to capturing 23% of India's retail market pie away from Reliance, Future and Spencer's. This is the growth story of how DMart, the retail king, grew slowly and steadily to become a behemoth. In this video, we'll break down the core growth strategy that has helped DMart crack India's retail market. How DMart's philosophy of buy it low, stack it high and sell it cheap works perfectly for India. How they crack the Indian consumer psychology of discount to make massive profits. And what's the real insight that makes retail work in India. I'm super excited for this one. Let's dig in. First, operational efficiency. See, Radhakrishnan Damani, the legend behind DMart, understood one core thing. In India, retail is all about operational efficiency. Efficiency churned out by cost, space, and employees. He was clear that efficiency is what will lead to healthy profit margins. And DMart mastered this by cracking 2 core aspects of their business. The first was stores. See, how Big Bazaar, Reliance and Spencer's operate is that they open rented stores inside malls and public spaces. They find it hard to own their stores because it requires massive capital requirements, but this is a core strategy for DMart. DMart chooses to buy and own their properties. The initial high cost of buying these properties proves well in the long run as nothing is spent on high rents. To optimize further, they strategically position their stores in suburban areas of metros or tier 2 and 3 cities. Their stores are often found in residential areas rather than expensive malls or high streets. This helps them maximize operational costs while catering to a broad customer base. They also understood that DMart stores have a clear job to be done, which is to enable shopping in bulk and for families. Unlike major retailers that have flashy interiors and luxurious experiences in fancy malls, DMart stands out by being absolutely basic with interiors. This helps them keep costs massively low. And you see what's happening, right? DMart wants to create a shopping destination for the Indian middle class. The idea is simple. Whenever you go to a DMart, you go with a list and buy goods in bulk and for the entire month. It fits perfectly for families looking to source ration after their monthly salaries are credited. Next, they took a super risky approach to marketing, but something that's paid massive dividends for them. So instead of spending heavy budgets on advertising, DMart made its customers market for them. What did they do? They offered the best pricing compared to anybody else. Trust me when I say this, prices at DMart are 6 to 15% lower than the MRP. Imagine getting such massive discounts. It is the biggest aha moment for anybody visiting DMart. And this is the core insight to DMart's business. Offer the lowest prices to discount-hungry Indians and they will take care of marketing for you. But how does DMart really offer such low prices? This is where their vendor strategy comes in. See, DMart is like a platform in the center. They have vendors on one side and customers on the other side. Radhakrishnan Damani understood that Indian customers only want one thing, discounts. And they figured out the best way to do it, maintaining great relations with their vendors. What do vendors want? They want one simple thing: payments cleared quickly. So while other retailers like Reliance, Future and Spencer's take almost 30 to 40 days to release payments, DMart, they do it within 7 days. This simple thing allows DMart to negotiate heavily with them, resulting in better deals and discounts, which they later pass on to their customers. And customers love discounts. This is a universal human trait. Whether you're affluent or middle class, everyone loves to think they're getting products at a low cost. DMart solves for this beautifully. By offering such discounts, DMart not only boosts sales volumes, but also attracts more customers to their stores. This increased footfall often leads to additional purchases of other products, creating a virtuous cycle of increased sales volume and max customer satisfaction. And then we have the real profitability driver for DMart. This is where it starts to get interesting. See, for DMart, food and non-food FMCG products act as acquisition hooks, therefore getting people in the door. They control about 72% of their revenue pie, but only have 12 and 2% gross margins respectively. But the real money is in general merchandise and apparel, which gives them a gross margin of about 30%. Now imagine you walk into a DMart store to purchase groceries. You buy your usual fruits and vegetables, and when you keep going deeper into the store, you come across a great looking t-shirt. It fits you, the price is not too high. You put it in your cart and move on. This is DMart's play for upselling products with higher gross margins to you. The customer's impulse purchase of the t-shirt contributes to DMart's overall revenue per square foot, which is 10x compared to Reliance Retail. Unlike Reliance and Future Group, who have downsized their store sizes and increased the number of stores, DMart has a different approach. They focus on increasing footfall for each store and making their stores bigger. The idea is to optimize for per square feet of revenue and make each store supremely profitable before moving on to build another one. Now, because DMart has access to exact customer behavior and buying patterns, they also see a massive opportunity with white labeling. Think about what Amazon has done with Amazon Basics, creating 100+ white label brands and generating $7.5 billion in revenue. They've quietly become a top 3 player in the battery space on Amazon and are doing wonders with apparels. And this is exactly what DMart also wants to do. And it makes sense, right? As they build more trust, people would love to buy DMart products from DMart. And it also allows them to have higher margins while offering super low prices that their customers love. This flows perfectly into DMart's product assortment strategy. But before we get into that, if you've been liking these Growth Insight videos, you will love our bi-weekly newsletter, Growth Shorts. It's subscribed by over 85,000 founders and growth leaders from companies like DoorDash, Uber, Google, Crore, Razorpay, you name it. The link to subscribe to it is in the description. Okay, back to DMart. Coming to product assortment. See, while competitors have tried to follow the latest fads and attract customers by ambience and tons of products, DMart has a different thing altogether. They embrace the Japanese Kaizen philosophy, offering customers the right assortments at the most affordable prices. Look at this chart, for example. DMart offers the lowest number of options with the least SKUs. The idea is simple: to focus on product categories with high demand and stick to the top selling brands. This approach avoids overwhelming customers with too many choices while ensuring they get the best selling and most popular options. As a result, DMart achieves higher sales volume and the fastest inventory turnover. Inventory turnover in retail is a term that basically means the number of times a business sells and replaces its stock in a year. DMart sells and replaces 14 times a year. That's triple of what Future does. And they combine all of these insights into how they open new stores all across the country. We're getting into the secret sauce of DMart now. Look at this map. You'll see a pattern here. While opening new stores, DMart consciously follows a cluster-based approach. This means it opens new stores near existing stores and distribution centers before even thinking of expanding across newer regions. Remember excellence in operations? This is just that. The concentration of its business in a small area enables massive supply chain efficiencies. Once a store reaches full utilization, DMart goes back to its playbook and launches a new one within a 3 to 5 kilometer radius. And this also unlocks something interesting. They have the 1 + 1 = 3 principle here. It's simple. 2 stores that collaborate well will be about 3 times as effective as each of them operating independently, because each will see what the other might miss, plus they can leverage each other's strengths constantly. For DMart, it helps them avoid overcrowding at mature stores by diverting customers to the new store, while that new store is busy attracting new customers, resulting in a higher overall footfall. This synergy between existing and new stores establishes a chain where each mature store helps establish a new one in its vicinity, leading to continuous growth. Also, there is an unsaid rule in the market that one must not open any store within a kilometer radius of DMart, simply because no one can really beat them on prices. But DMart's cost efficiency model is the real king here. Clustering also enables tons of brand awareness, word of mouth, and reduces the need for extensive advertising. Again, a win-win situation for DMart. Awesome! So those are core insights into how DMart became a $300 billion giant. I hope you found actionable insights from this video. And if you loved it, please do subscribe. We're building so much more interesting stuff here, and I can't wait to share them with all of you. I'll see you in the next one.